Hello. Welcome to KP Data Investing channel, focusing on stock investing and finding the diamond in the rough. Following our previous video elaborated about finding this diamond in the small cap stocks, today we are going to share the thesis of our recent purchase on a footwear retailer. If you are interested in our last video on why looking at the small cap stocks, I will leave the link in the description box for you. Without further ado, let's dive right in. This company is Footlocker, ticker symbol FL. In this video, we will present 3 reasons in detail of why we think Footlocker is a great buy to us. Remember to stay till the end of the video. Press subscribe and hit notification bell if you agree with our research work. Let's get started. For those who do not know about Footlocker, give us a minute to briefly explain their business here, taken from their most recent quarterly and annual reports. They describe themselves as the leader in bringing up sneaker and youth culture around the globe through a portfolio of brands, including Footlocker, Lady Footlocker, Kids Footlocker, Champs Sports, etc. As in their third quarter 2021 report, they operate more than 2,900 stores in 27 countries in the United States, Canada, Europe, Asia, Australia, and New Zealand. They have the business model that bridges the digital world and physical stores, including order in store, buy online and pick up in stores, and buy online and ship from store. For those who are familiar with Footlocker, you should know the biggest brands that they sell. In the latest annual report, they said they purchased approximately 91% of the merchandise from top 5 suppliers, in which approximately 75% was purchased from one single supplier. Sneaker fans and collectors should extremely well aware of the global phenomenon that many people are getting more passionate about collecting and trading sneakers. We don't think there is the necessity for us to further elaborate. So let's get into their fundamentals now. As we can see on the table reporting Footlocker's fundamentals from 2016 to 2021, the reported numbers are not impressive. Surely anyone who reads the numbers can tell that, how could this company is worth buying or even considering in the first place? We can see that red percentages are all over the place. Revenue was not growing in an extraordinary number year over year. Having said that their revenue was growing in low single digit, their reported EBITDA, net income, or earnings per share were even horrible, with all the dramatic ups and downs ending the compound annual growth rate in negative territory. But, from all the numbers shown in the table, there is one virtue we can find out in their reports. This number is also in negative, but in a good way. That is, the reduction in diluted shares outstanding in these 5 years at a negative 6.6% annual rate. What does this mean, and why is this a good thing? It is because they repurchase or buy back the outstanding shares from the marketplace so that they increase the ownership stake of all the shareholders. Generally speaking, a company buys back shares because they believe the market has mispriced their stock. This action offers an alternate and flexible way to return the company's value to their shareholder. Many companies buy back shares, such as the large cap stocks, Apple, Microsoft, and Google. It is not an uncommon thing for companies to do. The benefit of this move can be explained as simple as using the example of the numerator and denominator. The numerator remains the same, such as net income, but the denominator, which is the number of outstanding shares, reduced. The decrease in outstanding shares can directly improve many financial metrics that are reported in share basis, such as boosting the earnings per share, creating the increased return. Shareholders will not need to pay taxes on them until they sell the shares, but at the same time, companies can reward their shareholders in this way. Keep in mind of all these numbers we just mentioned. After explaining all these, we still haven't explained what makes us enter the market and purchase a stake of this company. Hear us out now. Here is the first reason that support our thesis in having a stake in this company. Take a look at Footlocker's valuation multiples in the past 10 years here. Basically, we extracted the next 12-month price to sales ratio and price to earnings ratio for exchanging our views. The light blue line is the PS multiple and the black dark line is the PE multiple. What we found was that the average PS ratio for Footlocker in the past 10 years was sitting at 0.82, while the average PE ratio was 11.95. Compared to the multiples we have right now, the PS ratio is 0.47 and the PE ratio is 6.58. In order for Footlocker climbing back up to the average multiples, we can find that there will be a 74% and 81% upside on PS and PE ratio respectively. Either these numbers seem to be a very attractive return to us as an investor. Even we only talk the multiples for the past 5 years, we can still expect a 38% and 54% upside on the PS and PE ratio. We believe that these numbers provide us a certain margin of safety to have a stake in the company. After talking about their undervalued valuation on the historical basis, are we done with our research and findings? Of course, that's not the only reason. Remember all these horrible percentages in the company's fundamental in the past 5 years? We have some more convincing reasons supporting our decision. Now let's look at our second reason. Looking at the estimates, we notice that the compound annual growth rate for Footlocker will significantly improve for the next 5 years. The estimated annual growth rate in revenue is going to be 5%, while EBITDA, net income, and earnings per share will grow at 12.5%, 14.9%, and 24.2%, respectively. Even though we could still see some of the negative numbers, this estimation, at least at this moment, tells us that we shouldn't be extremely pessimistic on their future growth. This massively improves our impression on Footlocker's fundamentals. And one more positive thing that should draw our attention is that their growth in earnings per share or net income are growing at a much faster pace than their revenue, which suggesting they are likely to continue the reduction in shares outstanding or their profit margin are forecasted to improve over the next 5 years. Either scenarios are both something positive for us as a shareholder. Of course, it is important for us to say that all these numbers are estimation and we do not know what the actual numbers will eventually be in the end. It is rather easy to predict the next 1 to 2 financial years, but definitely not predicting 5-year span. But at least right now, there are some positive and promising numbers we can look forward to. Now, take a quick look at their estimated free cash flow in 2022, which is about $473 million. This is an estimated number. The actual number will be reported when they release their earnings report on Friday. Just take the 473 million number as a reference for us to discuss our third reason of why we invested in this company. Of course, we could use the reported number in 2021 with $903 million. But we would rather take a more conservative calculation in our work. Let's get right into our third reason now. As we were creating this video, Footlocker is closed at $42.19 per share, which gives us a $4.24 billion market cap. Remember, the conservative free cash flow amount is $473 million. When we divide the free cash flow amount to the market cap, which is $473 million divided by $4.24 billion, we have come up with an 11.2% free cash flow yield. A whopping 11.2% yield with their free cash flow divided by the market cap. 11.2%. We would assume everyone who is watching this video knows what free cash flow means. Then, does anyone know what this yield means? Let's make a comparison here to fully explain how unbelievable this number is. The US 10-year Treasury yield is now at 1.9%. The general S&P 500 annualized return is 8% to 10%. The inflation rate, in latest number, is at 7.5%, a 40-year high. So do we now have a sense of what 11.2% means? If we presume They are going to take all this cash to buy back shares right now. We can easily outperform all the percentages we just mentioned on treasury yield, annualized S&P return, and the high inflation rate. There will be at least of 11.2% upside to us as a shareholder. They have more than enough money to continue repurchasing all the outstanding shares while continuing to pay the dividend to the shareholders. Very healthy number here. Not to mention their earnings yield is 20.6%. Also above the comparison we just made. Here, let's us recap all the reasons why we think Footlocker is a promising company to have a stake. First, we presented their historical valuation. And there are at least 70% upside using 10-year PS and PE average. Second, we noticed the improving annual growth rate in their forecasted revenue, EBITDA, net income, and earnings per share in the next 5 years. Third, the estimated free cash flow to their market cap is at 11.2%, which can easily outperform the US 10-year Treasury yield, S&P annualized return, and compensate the latest 40-year high inflation rate. Speaking of our buying strategy in Footlocker, we believe the current price is a perfect entry point. From our developed trading system, we calculated the stock price will be able to reach $57 in the short term and $75 in the long term. If the stock price will be able to reach these two price targets, we will consider rebalancing or selling all of our position in this company. Take $57 as a target. This stock will be able to deliver roughly 35% return. But if we take $75 as a target, this will provide about 78% return. Consider we will need a minimum 20% annual return and expect the stock price will reach $75. The time horizon for us to hold this stock will be about 3-year time period. As we said just now, if the stock price delivers a return much sooner and faster than we expected, we will consider rebalancing or selling all of our position. Let's take a worst-case scenario. If the stock is trading downwards, our strategy will be to averaging down for every 15% downward movement. We have extremely high confidence and conviction in our research and work. However, given the stock is about to release their last financial year results on Friday, we leave the final decision back to how this can accommodate our trading system. We cannot predict the price movement, and we are merely sharing our strategic plan and sharing some of our insights here. But we think all of these numbers point to a direction saying that this is an excellent buying opportunity. We have concluded our thesis of why we think Footlocker is a great buy for us. Thank you for watching the video. Press the like and subscribe button, hit the notification bell if you find this video useful. You will be notified when our latest video is uploaded to the channel. Leave your comments below if you have any thoughts about our work. We hope to continue sharing our findings in the stock market. Investing is for everyone. I will see you in the next video.